new true crime podcast you need to hear to believe.
I need police right now. I've just started broken into my house.
2 men dead at the hands of a teenager and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.
The Australian Financial Review.
Hello, ho, ho, ho! I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He's never naughty, he's always nice. It's Anthony Macdonald. How are you, Anthony?
Ready to recap a wild year, James.
Fantastic. This week we wrap up the year with our annual Chook Awards. We look forward to a huge 2026 on markets with one of Australia's top fund managers. And we take a quick peek at how the nation's financial engine is ticking over. But first, Anthony, we have to start by saying it's been heartbreaking to watch the awful scenes out of Bondi this week. And I think the nation will be grieving for a long time as we come to terms with this, well, really evil terrorist attack. Our thoughts and condolences go out to everybody directly and indirectly affected by this, and particularly Australia's Jewish community, which was brutally targeted. Anthony, it's an event that, well, really, it puts a lot of stuff in the corporate bubble that we inhabit. It puts it into perspective, doesn't it?
Sure does, James. Yeah, absolutely hideous attack. The scars this leaves for people that were there at Bondi, and what was a beautiful afternoon. You'd think there was nowhere better, nowhere safer in the world to be on a sunny Sunday evening like that. So, yeah, it was just absolutely shocking, tragic, and absolutely we have to do whatever we can to make sure this never, ever happens again. Not in Sydney, not in Melbourne, James, nowhere,
Yeah, well said, mate. And really, Anthony, not much news matters this week after that, but Treasurer Jim Chalmers still had to deliver the annual mid-year economic and fiscal outlook, better known as MyEFO. The headline news was that we're in a slightly better position than we expected. There was $20 billion in savings and a $32 billion tax windfall. Both of those are good for the budget. But let me get the maths straight here. Does that mean the budget deficit was $50 billion less than we thought?
James, just because we found a bit more of your income tax under the couch doesn't mean we haven't found a way to spend it.
Phew.
Oh, man, we've been hit with some costly stuff since the March budget. $6 billion increase for the states to hospitals, $5 billion blowout in the home battery subsidy scheme, which has gone much better than anyone expected, $6.3 billion for natural disaster fund, etc. So the net result is that, sure, we found these $20 billion in savings and got this $32 billion tax windfall, but we're only about $5 billion better off than we thought, James.
Okay.
So the deficit for this financial year is still expected to be a scary $36.8 billion, which is about as much profit as the big four banks make combined every year. It's a lot of money.
Yeah.
All right.
Yeah.
Other notable things, just generally, income and company tax are up.
Yep.
In the forecast. So the country thanks you for your contribution, James.
Pleasure.
But it shows the economy is travelling better than expected, which is a good thing.
Yeah.
Tobacco excise was down dramatically, like $2 billion this year,
Yeah.
$8 billion over the forecasts. That's because of the illegal smokes, which is a shocker for the country. What in it caught your eye, James?
Well, look, I think deficits for 10 years caught my eye.
Yeah.
I think the debt tips over $1 trillion next financial year. That caught my eye. That's a big one.
Big number.
But I think the biggest thing that caught my eye, Anthony, was the fastest growing demands on the budget. And there's 5 I'd take you to. So interest payments on debt, the NDIS, defence, hospital payments, medical benefits payments, and the childcare subsidy. Now, all of those things, totally understandable, all very important, totally worthwhile. But I put it to you, Anthony Macdonald, that we won't be cutting any of those anytime soon. So we're just going to have to live with big budget deficits, aren't we? As far as the eye can see, for as long as we can imagine.
Totally. I mean, they're all good things in good measure, James.
Yeah.
Problem is, I dare say they're all going to be increasing above the rate of inflation as well.
Yeah.
How do we put a lid on it?
That's the question. And I think it goes to some of the big issues that we've talked about over the year. Like, none of this contemplates the way the economy could be changed by AI. What if we did get either a big productivity boom or a big spike in unemployment? What would happen then? How would we have to restructure society? What do we do about this intergenerational inequality gap? Nothing really there that goes to that. How do we confront this problem with the tax base getting narrower? Where is the gap between taxing capital and labour, and how does that need to adjust? So look, it's the end of the year. No one wants to try and address those big issues with a few days left before Christmas, but they're not going away. And I think at some stage, we're going to have to tackle them.
Yeah, a few big topics for Westpac boss Anthony Miller to talk to his dad about at Christmas lunch, James.
It's the most famous Christmas lunch in corporate Australia, Anthony. Okay, Anthony, let's break out the chicken and egg yolks because it's time for our annual Chook Awards, where we peck out the good, the bad and the ugly of the corporate stories that made our news in 2025. Anthony, I know I say this every year, but it really has been an extraordinary period. Donald Trump chucked a fox in the henhouse on Liberation Day when he announced tariffs on everyone, including the penguins of Heard and Macdonald Islands. And as we know, penguins are chickens in tuxedos, so we feel a special affinity for them. Markets are going to finish 2025 with another year of exceptional capital gains. And yet when I look back, I mainly see some truly rotten decisions and missteps from corporate Australia. So let's get on with it. We've got 5 categories, and the only rule, there's no walking on eggshells here. Let's get the roosters out of the bag. First up, it's the Excellence in Business Award for a CEO or company that excelled in 2025. Lead us away, Anthony.
Going left field, James. I'm going Eagers Automotive, car dealer. Competitive industry.
Okay.
New car sales have been softer than last year, every month this year in Australia. There's big changes going on. It's all about EVs and hybrids now. And it's you'd think it's sort of a tough time in the market. But these guys have picked up 14% of the new car market share now, up from only 10% last year. So 4% gains in the space of 12 months. $13 billion turnover, up from $10 billion or so last year, 15% compound growth over the past 10 years. They had 19% of the electric vehicle market. They're now up in the 30s. They're absolutely firing on all cylinders. And like I said, James, it's in a softer market, and they're doing something old world, like selling Toyotas and then trying to bring in the new cars like the BYDs. So, I take my hat off to them. The share price, it's doubled in the past year. It was up 3 times until a month or 2 ago. Came off a bit in the past month. Now, the thing I like about it, James, we go on about M&A deals being risky, particularly offshore ones. These guys did a step-out transaction this year. They bought a Canadian business called Canada One, or a big stake in it at least, which adds about $5 billion in turnover to the business. Obviously, M&A is very hard to make work. Fund managers would say 9 deals out of 10 like this fail. Bankers would say it's 50-50, whether it works or not. But, I applaud that it's trying, and I applaud that it did it when the shares were up, 3 times on what they were 12 months earlier. So they did it when their price was high. It was good time in that way to raise money to actually chase it, and they're having a red-hot crack. So hats off to them. They're going to be added to the ASX 100 next week just to cap it all off. What about yourself, James?
Well, did you say that Eagers shares had doubled?
Doubled in the past year.
Oh, it's good, but it's not as good as what happened at Firmus. In 6 weeks, the value of this company tripled from $1.9 billion to $6 billion. Now, Firmus is part of the AI revolution. They have a unique cooling technology that cools those computer chips, and now they're getting into the AI factory business with backing from NVIDIA. But look, you can have your Jensen Huangs, you can have your Sam Altmans. The founders here, including Oliver Curtis and Tim Rosenfeld, have done a spectacular job of building the momentum around this business. Look, I've got no idea if Firmus makes it in the end. I think some of these cloud and data center providers are going to have Some of them will have hit the big time and some of them won't. But the momentum here, I think, is part of the big story of the year, and that's AI. And to be able to triple your valuation in 6 weeks, you're really selling the story, and good luck to them. It's been an incredible ride.
Wait for the next racing, James. Seriously, you think triple's impressive?
Yeah, well, maybe.
Next up, James, we're going to pull out the Rooster Booster Award for the CEO or company that delivered a 20-kilo pile of crap.
Anthony, it's got to be corporate travel management.
Oh, yeah.
Oh, man.
Yep, good nomination.
Notionally, this thing is worth $2.4 billion, but its shares have been suspended since August, and we've got no idea what this thing's worth because it is going to come back onto the market having revealed that it's overcharged British customers, including the UK government, to the tune of about $160 million. Now, this has been a embarrassing scandal. So the company gets its shares suspended in August and it says, we've just got a couple of issues that the auditors found. Nothing serious, don't worry. In about a month later, it says, those issues, they're all timing issues, non-cash timing issues. It's all good. Comes out at the end of October and says, we've figured out we've overcharged the British government. And now we're going to have to repay all that money. Incredibly, the CEO, Jamie Ferris, who's also the founder, is still there, and the chairman, Ewan Crouch, is in place. They reckon they can get through this. I reckon this company's going to be very lucky to survive in its current form. Absolute takeover target when its shares come back and trade, and they will fall, I don't know. It's anyone's guess. Is it 80%? Is it 90%? Is it 95%? Who knows? But this has just been an absolute disaster, and it's a slow motion car crash. It's funny that this has played out over 6 months and it's still not done. So it's a very unusual disaster. But look, it's one of the greats, and we had a big field to choose from, Anthony. Who was your selection here?
Look, James, I'm going with someone who brought financial engineering to the hospital sector.
Yes.
Left a major company on life support, and that's Canadian Brookfield and its investment in Healthscope, the number 2 private hospitals operator in Australia. Mate, Brookfield walked away from the investment in May. It handed control to Healthscope's lenders. The seeds of this demise were sown in 2019, James, when it bid really hard for Healthscope.
Yeah.
It had to win an auction, or it felt like it had to win an auction. And it agreed to sell 24 of the hospitals via sale and leasebacks. It make promises on the rent to the buyers of those properties to get the big valuation on the properties, and loaded it with debt, all of which was required to make this big leverage buyout work. The COVID hit, cash flows came under strain, never recovered. It's an issue for every hospital group out there, James, but it's the biggest issue for the one with the most debt and the one that PE had pushed the hardest. And it all came to a head in May. Like I said, it handed the company to the lenders, had tried to wheel and deal its way out of it to no avail.
Yep.
They probably felt like they either had to inject a whole heap of money, which they didn't want to do, or pass Healthscope on to the next owners. So, I will say, James, one thing about Brookfield, it didn't trash the joint on the way out, at least.
Yep, true.
But by my calculations, it dusted about $2 billion in equity, which, if that's not the biggest loss ever in Australian private equity, it's got to be top 3. And it did it on a safe as houses, hospitals investment, government money backed, aging population, safe market like Australia, all that stuff, because it juiced up the capital structure just to get the deal done in the first place, and was a real doozy.
Yeah, absolute rooster booster stuff there. Okay, our third award, the Rotten Egg Award for the stinkiest deal of the year. You're our deals man, Anthony. Lead us away.
Well, you got to go with the big bopper, James. Always go with the big bopper in deals, and that's Santos. Abu Dhabi's national oil company combined up with Carlyle, the big private equity group, to buy it. And what could go wrong? The Santos board, they got a bid. They got the bid up to a level where they thought, all right, that's a good price. It was about $8.90 a share. Due diligence starts. Everyone's happy. XRG, as the consortium called itself, they want to invest in Australian gas. They want to do all these good things for the country. It's all good. The stories start coming out about FIRB concerns. Not a problem, according to Santos and the XRG camps. Don't worry about it. Don't worry about the former Santos chairman saying that this might attract FIRB scrutiny. So due diligence gets underway, and then it just gets extended. You could sort of sense things souring between the two camps, and it finally came to a sort of put up or shut up moment, and then XRG, the bidder, pulled its bid. Why? I'm not sure we really ever got to the bottom of it, to be honest, James, and that's our fault as much as anyone's. A few issues came up in DD, but nothing, came out publicly that I thought would absolutely be the killer thing that would see the deal collapse.
Totally.
I mean, that's okay. These things happen, but to happen again at Santos, it's been down this path a few times now. Woodside did due diligence. Harbour Energy, another private equity group, did due diligence. No binding bids. So it's not good. And then the Santos CFO leaves, right? And it emerges there's more to that story. Claims she was shown the door by the chairman after a culture clash with the CEO, Kevin Gallagher. Investors were scratching their head around that and some of the messaging about it as well. And I give it the stinkiest deal, James, because there's just a smell coming off this one.
It's going to linger into 26 for sure.
Yeah. Who are you nominating for the Rotten Egg Award?
Well, you've gone the big bopper, I've gone the big stinker. James Hardie started the year absolutely assuring investors that it would not go out and do a big deal. Guess what it did in March? $14 billion transaction to buy a US decking company called AZEK, and investors hated it. They didn't like the deal itself. They reckon James Hardie had overpaid for the business. That's all fair enough. That happens. But what they particularly didn't like is that they didn't get a say on the deal, and they didn't like the way that they were treated by the James Hardie board and the management team. And investors got their revenge. Came to the AGM. The chairman, Anne Lloyd, was voted off the board along with 2 other directors.
Bye-bye.
Leaving James Hardie in a bit of a mess. I've never seen anything quite like this, where not only do the investors get angry about a deal, but they actually do something about it and change the board. So this has just been a classic for me, and I reckon James Hardie's going to be rebuilding trust with investors in Australia for many years to come.
All right, James. Let's move on to something a bit better. The Sunny Side Up Award for the feel-good story of the year.
I love rich list stories, Anthony. You know that, particularly the great immigrant stories of Australia, which is so plentiful. Dennis Bastos, his parents arrived here from Greece when he was a kid. He wanted to design cars, but eventually got into business, eventually got into making generic pharmaceuticals, and he became the biggest company doing that in Australia, DGB Health. In the middle of this year, he sold a 25% stake in the business to a big US group, valuing his company, DBG Health, at $7 billion.
Wow.
Now, we don't get too many overnight successes in Australia. And of course, this isn't an overnight success. He's been building this business for decades. But to have a $7 billion company sitting there that we didn't know about, I reckon it's just a great reminder that Australia remains a place where risk takers can be rewarded. We got the right ingredients to build great businesses in the right circumstances. So well done, Dennis. Anthony, who do you like here?
You love a rich list story. I love a comeback story, James. So I'm nominating Virgin Australia.
Yeah.
It was broke, and importantly, it was allowed to go broke. Private equity steps up in an auction, buys it, manages it through COVID, steadies the ship, rides the revenge travel story, tidies it up a bit, makes the most of good times in the sector, the demand dynamics, the market structure, and spins it back out in public markets, which was always the plan because there's no other real buyers for a domestic airline like this globally, James. And it couldn't have worked much better for Bain Capital, the private equity firm.
Yeah.
I'm not sure it could have worked out a lot better for Australia either. This is something we let go broke. Australia, us, you and me, the balance sheet, the National Reconstruction Fund wasn't there. We didn't try and prop this business up. We let the market work it out. The market worked it out. They steadied it, tidied it up, slimmed it down, got it more focused, put it back into public markets. The float probably took, a year or two longer than Bain would have liked, but it got there. It's traded reasonably well. For me, it's a good affirmation of public markets. It shows that private equity can have a role and can tidy up these sorts of businesses for us. So I liked it.
Yeah, good. The penultimate award, the Easter Egg in Summer Award for the CEO or company that melted under a bit of pressure. Who's your nomination here?
Well, I was going to go corporate travel, James.
Sorry,
but no,
Anthony.
That's all right. I've got another one up my sleeve. I'll go with Optus. All right. You couldn't script it. Stephen Rue, the CEO of Optus, stepped on stage at our Cyber Summit in September, recounting all the lessons Optus had learnt from its outage debacle 2 years prior when Kelly Bayer Rosmarin was in charge.
Yeah.
So he's on stage at the summit, James. He's sitting there with a little piece of paper. He's got a list of lessons. I think there was about 7 lessons. He came prepared. He wanted to, first question that gets thrown to him, he pulls the paper out of his pocket. He's ready to go. He's ready to show us how much Optus has learnt from its shocking moment a couple of years earlier, the one that he wasn't around for, but everyone, the new Optus, has learned its lessons. Things like it starts with the CEO, the responsibility for security and security culture has to start with the CEO. It's all about open, transparent relationships with government and regulators. You need to practice your response, know what to do in a disaster, make sure you got the right numbers of the ministers, communication plans, all that sort of stuff.
Yeah, love it.
Only for a couple of days later, Optus had the 000 outage. It later came out that Optus and Nokia, which manages network operations for it, they'd been trying to do a new firewall upgrade to roll out through the network. They had 000 call failures linked to 3 deaths. So that side of it obviously is horrible. But as Paul Smith, our tech editor, wrote so nicely, those tips didn't look like the piece of paper they were written on at the summit. And it's just the timing of it all. There's an absolute shocker for Optus.
Yeah, good nomination.
What about yourself? Who do you think melted under a bit of pressure?
Oh, Drone Shield. This was the hottest stock on the ASX until a couple of months ago. The stock climbed 780% from the start of the year to early October. But then the CEO, Oleg Vornik, and the chairman and another director made the bizarre decision to not just sell some of their stake in the company, they sold every single ordinary share they owned, including the stock that they'd just converted from options a couple of days before. Now, we still haven't got a good explanation as to why they did that, and not a public one at least. But this has just smashed the reputation of the company. The stock's actually had a decent run in the last month or so. I think it's up 40% since the start of December. So there's still some true believers out there. But I think just the way Drone Shield handled this was really poor. We sometimes get companies that go from being very small, they have a cracking run, and all of a sudden they've got a very large market cap. What's got to happen, though, is that the governance and the systems and the processes around those businesses need to reflect that rise, and so often they don't, and the companies get caught out. So, yeah, just a bit of a mess here.
Yeah, good one, James. All right, our final award, the Put a Wing on It Award for the CEO or company to watch in 2026.
Oh, I'm going global here. Sam Altman and OpenAI. Now, young Sam's been running around the globe spending like a crazy man in the last 6 months or so. OpenAI's got $1.5 trillion US worth of spending commitments out there.
Wow.
And about $20 billion in revenue at the moment to pay for it all. I have no idea how the financials of this work. I love the FT's description of OpenAI as a money pit with a website on top of it. I think it's probably a bit unfair, but it's very appealing and nicely done. So I think where the AI bubble goes depends on whether people still believe that Sam Altman and OpenAI can pull off all that spending and make good on their big AI promises. So I think that's what we've got to watch. There's a few big stories, but where AI goes from here is going to be really important to where not just markets go, but where economies go, because so much of the capital expenditure in the US and even in Australia is being driven by data centers related to AI.
That's such a good nomination, James. OpenAI, that's the real big one. I think like a year or two ago, we would have said that was NVIDIA, right? And it's proved itself. And now OpenAI is like the frontier.
Absolutely. Anthony, who do you want to keep your eye on?
I really struggle to compete with that. I'll go locally though, and I'm keeping my eye on Endeavour Group. So that's owns the bottle shops. Dan Murphy's BWS owns pubs, the old ALH big business, the biggest pubs owner in Australia.
Yep.
Jane Herdlicker starts as CEO on January 1, a public holiday for a lot of us, but not her, James. That's her first day properly on the job. Now, Endeavour's one of Australia's large cap laggards. It got spun out of Woolworths 5 years ago. The separation, in hindsight, was rushed, and it hasn't quite found its feet as a listed company. Jane's been hired to shake it up, and her track record is she does shake things up. Most recently, Virgin Australia.
Yeah.
She's a busy executive, and there's always a bit of a drama around her. She's been heavily involved for 6 months or so in the background at Endeavour. All these rumours flying around about, splits to the business and all this sort of stuff. I reckon we'll see it's a really big year for them, James. I mean, the opportunities to unlock a sleeping giant here, but I'm not sure you ever get a smooth ride. Jane or a major shareholder of Endeavour, which is the Matheson family.
Yeah.
Bruce Matheson Sr., and although it seems like a lot of the decision-making is passed to his son now, Bruce Matheson Jr., that's one to watch, James.
Yeah, Anthony, I'm going to make a solemn promise. Jane starts on January 1. I'm going to get to either a Dan Murphy's or an ALH pub on January 1 and do my bit, hair of the dog after New Year's Eve, and start the year off right for Endeavour Group. Give them a fighting chance. So I hope many of the listeners will be with me on that.
Good plan.
All right, Anthony, great to look back at 2025, but I reckon 2026 is going to be just as exciting. To have a look at the year ahead, we've got a very special guest. Back after the break to look at the themes to watch in 2026 and some stocks to watch.
A new true crime podcast you need to hear to believe.
I need police right now. I'm just stabbed and broken in my house.
2 men dead at the hands of a teenager and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.
Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox.
Okay, James, our second great tradition on our last podcast of the year is that we bring in one of the country's top fund managers to help dissect the year that was on markets, look forward to what's coming, and maybe even nominate a few stocks to watch. And so we are thrilled to welcome back to the podcast Katie Hudson, Head of Australian Equities Research at Melbourne's Yarra Capital Management. Katie, thanks so much for joining us again at the end of a massive year. Have markets been kind to you?
Thank you so much, Anthony and James. It's great to be here again. Markets have been kind, a lot of volatility, but the small cap market's been up over 20%. Unfortunately, despite a pretty big headwind from gold, we were able to outperform, so we were pretty pleased with that. But within that, a lot of ups and downs, and as I said, a lot of volatility, and volatility that I think is here to stay, partly a function of the characters we've got on the stage at the moment,
Yes.
and partly a function of the changing ownership of the market.
As you said, there are some fabulous characters on the stage and some huge themes across the year. You know, Donald Trump got into the White House and then we had Liberation Day in April. We've had this AI drumbeat, which has sort of risen and subsided a touch towards the end of the year. We had an election in Australia, which tends to sort of overshadow things for a little while. But for all that, it feels like markets have come through okay. And there's this idea in markets that sort of nothing ever happens and you just keep your head down and it'll work itself out. Do you feel like that, or has it been difficult to navigate all these ups and downs?
Yeah, it's definitely felt difficult. All that volatility has definitely increased, and all the things you've referenced there have definitely contributed to that. But ultimately, earnings growth has come through, and particularly in the small cap part of the market. They delivered probably about 10% higher earnings growth than large caps, and the share prices have followed that. So, and I guess the other thing for us has been volatility has created opportunity.
Yeah.
For us, it's been very much around staying true to the timeframes that we invest against. So it's that 3 to 4 year time horizon. And so when Liberation Day came, when markets sold off, we leant into that and we were adding risk. And that, fortunately that proved to be the right decision. But, amongst the volatility, there's definitely been opportunity.
Had you almost been waiting for that Liberation Day type opportunity? The markets have been strong for 2 years. It had been tough to find value, but all of a sudden you get this air pocket that creates an opportunity for an active manager?
Yeah, I felt like there's been opportunity all the way along. There's been definitely pockets that have had extreme valuation. One of our analysts calls them the meme stocks, but there's definitely been a lot of pro-cyclical, earnings-driven momentum. The drone shield, for example, getting to $5.5 billion of market cap before, someone wakes up and realises that when a whole lot of insider selling happens and you've only got $200 million of non-recurring revenue, that might not make sense.
Yes.
But within that, there's been actually a lot of opportunity, and fortunately, we've been on the right side of enough of them.
Katie, you've obviously had a very good career in markets, and you get to the end of the year like this. What do you think 2025 will be remembered for?
Yeah, it's a great question, Anthony. I mean, one of the big themes that really stands out for me is the year that the founders came unstuck. Australian investors love their founders. We've typically rated them at a higher multiple and we've given them a lot of leeway. And I think this year was a year when we had several founders who came unstuck. And the subtitle to that story could also be "Even Founders Need Strong Governance Guardrails to be Successful." And if you look at the founders that came unstuck, that was a pretty common theme, that the founder guardrail governance wasn't strong enough. And in fact, there's probably some argument to say that the governance should be stronger to offset the founder strength of the personality. So hopefully that's a lesson that the market's learnt, because it's been very consistent and a big theme.
Yeah, so we had Drone Shield, Wise Tech, Mineral Resources. Did you get caught on the wrong side of any of those?
And corporate travel.
Corporate travel, of course.
Yeah, unfortunately, no, we didn't get caught on the wrong side of any of those, but we don't take much pleasure from it, because we know as investors that our mistakes are around the corner, and we stay paranoid.
Yeah, fair enough. You mentioned how strong a year it's been for small caps. What's driving that rotation? And can I just get you to reflect in there about... You mentioned market structure in your first answer. That's all obviously a lot about passive and how money's flowing into the market from passive investing and superannuation investing. Does that help a small cap investor, or does it work against you, or can it do both?
I think for the longer term investor, it's definitely creating more inefficiency and more opportunity. The short term is a random walk. So it's all about who's setting the price.
Yeah.
And so as you've got nearly 30% of the market owned by passive, they don't care about price. They don't care about valuation. In fact, by definition, they're valuation agnostic. And so what you've got is a lot more influence from some of the shorter term trends like quant and systemic trading, having a much bigger impact on price setting in the short term. And, that's obviously a random walk in terms of how it impacts markets. For us, though, as longer-term investors, I think it's creating a ton more inefficiency. It's just taking longer for that to play out. So what we see during reporting season is everybody focused on, did they meet or beat?
Yep.
What's the guidance, and, what's the last 6 weeks trading?
Yeah.
But for us, it's very much about, within that, the inefficiency that's getting created by a company that has a misstep, or, long-term structural growth that's not well understood. And so for us, I feel as though the opportunity's actually got a lot larger.
So if a company gets sold off for missing its earnings expectations or having a bad trading period, but you like the story, you're able to get in and perhaps buy a few more shares more cheaply, but you do have to be patient in waiting for the market to reflect the underlying value that you see in that stock.
Yeah, spot on. I think that's absolutely right. And Liberation Day, as I mentioned before, was a great example of that. Breville got sold off really hard because they've got a US business. Half of their earnings comes from the US. On a 3 or 4 year view, there's an argument to say Breville will be a stronger company by virtue of the tariffs and the moats and the initiatives that management have undertaken to move their supply chains. And selling that stock off really hard on the back of that thematic, felt like an opportunity to us, and we stepped into it.
Yeah. Has it started to turn?
Yeah, it's definitely been a good contributor. It's definitely rallied. There's still a bit of volatility on a, do we love the US? Are there tariffs coming, on a day-by-day proposition? But, in that 3 or 4 year view, it's definitely the business is performing well.
Yeah, yeah.
Katie, in your hunting ground of small caps, you mentioned gold's impact before. I think gold's up to about 15% of the Small Ordinaries Index now. How have you gone about that? I mean, have you been investing in these gold stocks? Because they've driven that Small Ords return this year. Have you been able to capture it, or did you miss it, or how have you gone about it?
Yeah, it's a great question, Anthony. So it peaked at actually over 20% of the Small Ords.
Wow.
And you're right, it's back to about 14 or 15% now, but not because the stocks have underperformed, it's because a lot of them have gone into the ASX 100. So the mid-cap part of the market is now rife with gold companies, I think at an all-time peak as we sit here today. And so for us, it's been the battle of the fundamental investor versus the macro. The fundamental investor would say gold has no value in use. 75% of it's recycled, so we don't actually consume gold.
Yeah.
It just moves around the world. And there's no relationship between the cost of producing gold and the gold price. And in fact, most gold companies have been terrible returners over time. And the last couple of years, most gold companies have actually been in production downgrade mode and have had cost inflation. And so when you buy a gold equity, you're not just buying the gold commodity price, you're also buying that production risk, you're buying that cost inflation risk, and you're buying the geopolitical risk, which, by the way, has been evident for a number of the African companies who are having a bit of a battle with the governments of some of the countries about whether they can retain ownership. So the gold equity investor, might look at that from a fundamental lens, but the macro has been pretty clear, and with the benefit of hindsight, which, certainly we didn't predict, has been pretty simple. That is the debasing of the US dollar. We needed another currency to give us a safe haven, and gold's been that safe haven. So it's been a one-way story. We have owned some gold stocks. It has been a big headwind for us because we like to own companies that we can feel confident about the gold equity, not just the commodity. And then we also had a couple of companies like Imdex and Chrysos, who are really great global market share winners who have exposure to the gold end markets, and they've been beneficiaries of that as well. So overall, it's been painful, but not enough to wreck the year.
So lots of investors would find themselves in this position too, where they've got a view on a sector, I don't love gold stocks for all the reasons you've mentioned, but then they see the performance of gold stocks, and does part of you start to waver, or is that when you have to say, I've got to stick to my principles here and just ride this out? Is it tough to do when you're in the middle of the sort of storm?
Yeah, it's really tough, and you have to have an eye to risk as well. Yeah. So it's unusual for a commodity to have that big an impact on the benchmark. Lithium's sort of been up and down over periods of time, and has had an impact on the benchmark, but nothing that extreme that we've seen for gold this year. So you have to have an eye to risk management as well. But ultimately, it's about just staying true to, exactly as you said, James, the timeframes you invest against.
Yeah.
And hopefully, and crossing your fingers.
Well, it's good to hear the even professional investors have to cross their fingers a touch too. Okay, so Katie, you mentioned a few really big themes there: debasement of the US dollar, the turn to gold. Obviously, we've talked about Trump and AI. What are some of the themes you're thinking about as we head into 2026?
Yes, I think AI is going to still be a very, very big theme for 2026, but I think the conversation is going to shift a bit. I think, one of the lessons for me from the dot-com era and technology adoption is that it's actually a lot easier to pick the losers than it is the winners. And I think the conversation next year is going to be more about who the losers are.
Okay.
And for us, we think through a lens of, where's the human intermediation of information, and particularly where there's high margins. I think those sort of industries are going to come under pressure.
Yeah.
And I think we're going to have a lot more conversation about who the losers are. I think a couple of members of our team have just spent some time in the US, and their observation is the use cases for AI are so much further advanced than they are in Australia.
Okay.
And I think we'll start to be having a lot more conversations about that in Australia next year, and starting to value that into share prices. Who's winning on the use cases, who's developing them, and how do we value it?
Yeah.
Hopefully not like we did in .com, which is about eyeballs. Hopefully it's a bit more fundamental than that, but I think that'll definitely be the case.
Is that going to be a challenge though? Because there is this question, we've had a technology change like cloud. Everyone moved to the cloud, but the only people who really made any money out of it were the cloud producers themselves. Are you worried about that happening again? Everyone moves to AI, but the winners are, people selling AI models rather than the companies themselves?
Yeah, I think there'll be companies that benefit, but I think we've got to remember that AI is actually a really capital-intensive and OPEX-intensive technology adoption. And so there'll be a cost to that. So whether you just say, here's a labour productivity opportunity without a cost, I think that's naive. So we're thinking about, the whole picture and how the value chain, to your point, is moving. And probably the other one, just to wrap up the AI conversation, is we're pretty strong believers that a lot of the AI valuation bubble is actually in private markets, not in public markets.
Yep.
And so I think, whether 2026 is the year we see evidence of that, I think 150 neo clouds with crazy valuations and vulnerable business models, once liquidity starts to be required for those valuations, then you start to see the valuation reality moment. Whether that's 2026 or not, I don't know, but there's a private market valuation reset coming at some point.
What are some other big themes you're worried about?
Yeah, so the other one, and a little bit on that theme there, is about liquidity. I think we've forgotten to value liquidity in markets. And, certainly people have moved out the risk curve. Your future, your super has definitely been a driver of that. A lot of super funds and a lot of private investors have moved out the risk curve to get higher returns, and they've taken a liquidity risk for that. So I think we've forgotten to value liquidity. And, one thing I do worry about is when we do have that liquidity moment. And probably the other one is just this two-speed economy. A CEO described it to me the other day as being, particularly in the US, it's like a K.
Yeah.
You know, if you own equities, you're feeling good, you're at the top of the K. If you don't own equities, you're at the bottom of the K. And those sort of things are really concerning. You can't have a sustained environment where economies and people feel very differently about their experience, and that has to be rationalised at some point.
Yeah, no, agree.
All right, Katie, we hear that you're looking out for the losers, but we all want to be at the top of the K. What have you got in the portfolio that you think's in for a good 2026?
Yeah, Anthony, I'm going to make a big statement and say fundamentals are starting to matter again.
Okay.
Because it's been a year where it hasn't felt like fundamentals have mattered all that much, but it does feel as though we're starting to get a bit of a reality check on that. So against a backdrop of fundamentals starting to matter, you know, we love compounders. Companies that are compounders, compounding earnings, companies like Auckland Airport, I think are starting to see some growth in airline capacity. You know, dare I say the New Zealand economy is showing the first signs of starting to improve. And Auckland Airport also has the ability to deploy a lot of capital at really attractive rates of return over the long term. So, you know, that's a long-term one that we like. We've got a different view about interest rates than I think the broader market as we sit here today. And I think Centuria Capital, as a property fund manager, if we're right on interest rates, they should be a big beneficiary. If we're wrong on interest rates, I still think they'll do well.
Your view is rates aren't going to go up as...
Our view is rates aren't going to go up. So Tim Toohey, who's our head of macro and strategy, who's way smarter than me on these things, you know, I think we've got a view that the bond markets are starting to behave a little bit like equity markets in that, and that's not a compliment, in that they've been a bit more volatile and extrapolating the last data point. And they've tended to do that and been whipping around. And Tim's view certainly is that inflation won't prove to be as stubbornly high as it appears to be. And certainly when we talk to companies, they say there's capacity in the labour markets. Where the labour markets feel tight is more around healthcare and particularly the NDIS.
Okay.
And so, yeah, for a whole range of reasons, we think interest rates are actually still heading down, not up.
Right.
So Centuria should be a beneficiary of that. And probably the other sector that I've actually been surprised we've read little about that's actually booming is actually the contractor sector.
Okay.
We counted over 15 contractors listed in the Australian market at the moment, and they're all booming. It's a bit around defence, around some of the resources sectors like gold and copper, etc.
Yep.
But it's also about renewables and electrification and all those things layering on top of each other. If you actually wanted to believe the energy transition is real, just talk to the contractors because they're the lead indicators. And they're all having an absolutely fantastic time.
So is there a name or a couple of names that jump out?
Yeah, so we've been long-term holders of Monadelphous. They're doing really well across all of those dynamics. But yeah, it's pretty much pick a contractor at the moment and they're having a good time.
Okay, that might be one for us to follow up there, Anthony.
Good idea, yep.
And good to hear Katie's on the, Katie and Yarra Capital are on the Anthony Macdonald no need to move rates for some time bandwagon too. All right, Katie, we love listener questions here on the Chanticleer podcast. Thanks to all the listeners who've sent a question in across the course of the year. Our last question for 2025 is from Joel in New South Wales. If you've got a question you want to send in for next year, you can email us at chanticleer@afr.com. You can also send us a question audio form. Just record a voice memo on your phone and include your name and where you're from and email it to us. And of course, the Chanticleer widget on all our articles at afr.com allows you to ask questions too. So Joel says, Australian CEOs are often urged to invest more in Asia to diversify away from traditional markets. Beyond geopolitical risk, what are the primary regulatory or cultural barriers holding them back compared to the relative ease of doing business in the US? Now, we've got you here, Katie. When you hear a small cap say, we're going to Asia, we're sure this will work, do you start to get nervous?
Look, I think the key thing is it on strategy and what are they taking? Are they taking a competitive advantage when they go there? So there's too many companies that just do acquisitions because they're EPS accretive, and we've seen, companies like Ramsay Healthcare over many years make EPS accretive acquisitions that have been a complete disaster. So what we want to see if they're going to any country, including Asia, is that it's on strategy and that they're taking something with them that gives them a competitive advantage in that market. If they do that, then, great. We're excited about companies expanding offshore. I did have a little chuckle to myself about the relative ease of operating in the US. Although having said that, one of the themes this year has been regulation dropping in the US and companies are finding it a lot easier, particularly in the resources sector, a lot easier to do business. In terms of Asia, I think obviously we think a lot about that geopolitical risk, but it's also about the cultural risk, about the ability to get money in and out of countries, some of those elements are really important.
Yeah, Anthony, I mean, one of the things about Asia when you speak to CEOs and investors is there's a danger that you think Asia is one market when it's actually lots of different countries, and even within those countries, various regions can act very differently.
Yeah, absolutely, James. Dozens of countries, dozens of languages, dozens of different cultural practices or barriers, as Joel puts it in his question. We think of Asia as just this big block up there, and it's easy enough to trade with, but it's so much more fractured than that.
Yeah. The Australian government is doing a lot of work to try and get more Australian business done in Southeast Asia. That's probably a really smart idea to diversify, not so much away from the US, but China and establish some bigger trade ties. That's where the growth in the global economy is going to be over the next few decades. So that makes sense. Katie, we are on the precipice of a nice summer break. I know our listeners out there will be looking for something to occupy their time while they're on the beach or going for a nice long walk. Have you got a recommendation for us, a book or a podcast that you're looking forward to getting into, or they should get into?
So I'm just rereading a book called The Outsiders by William Thorndike. I've read it before, but I absolutely love it. It's a bit talky because it is about 8 CEOs who talk about the history of how they were successful.
Okay.
And at its heart, it's about a capital allocation story, which is probably super talky.
Yeah.
But, I just think it's a vastly underrated and probably old school process. And I think just understanding how companies create value to me is so fascinating.
Yeah.
This book talks a lot about that. So I love it and I'm rereading it again.
What a great recommendation. Anthony, speaking of super dorky.
I can't match that, but I do like the sound of a nice capital allocation read over summer, James. I got given the book Apple in China by Patrick McGee. Looks at, Apple went offshore in the late 90s, I think, early 2000s, and then how it used China's affordable labour, to put it nicely, to really fire up the whole company and move to this position of real global powerhouse. So I'm looking forward to reading that. What about yourself, James?
I've got a couple. I just got given the Aaron Ross Sorkin book, 1929, on the sort of lead up to the Great Depression. Apparently it's terrific, so I can't wait for that. Chris Kohler, one of our colleagues at Nine, has a book out called How They Get You, which is about all the tricks that companies use, to make you subscribe and make you buy and make you do things that you don't want to do. I don't know if anyone's spent any time on Chris's Instagram account. He does these fabulous two-handed interviews with himself where he lampoons business. Very cutting and good stuff. And just a podcast recommendation. I was recommended the podcast Scase on ABC Listen. Fantastic. It charts the sort of fall of Christopher Skase and his status as a cultural figure in the 80s and 90s. It's really funny, very digestible. Some great Australian journalists feature with some great tales from the time. Some of the Christmas parties that he had just sound amazing. We've got to bring that era back.
And James, that would be Christopher Skase, formerly of the Australian Financial Review.
Yes, Katie, thank you for reminding us of one of our great alumni. Good point. It's great fun. So when you've done listening to all the episodes of the Chanticleer podcast from the year, go and re-listen to them. But after that, you should go and listen to Skase.
Skase, I sure will.
Okay, Katie, thank you so much for coming in. We really appreciate you coming on the podcast. Glad you've had a good year, but rest up because I reckon 2026 could be just as exciting as 2025.
It's a pleasure. Thank you so much for having me.
Thank you, Katie. Merry Christmas.
Now, Anthony, I'm a bit nervous about this next bit. Over the last few weeks, our super producer Mandy Coolin has put a call out for some feedback for us from our dear listeners. I am not really sure how this is going to go. I haven't heard the package, but Mandy, maybe you can tell us a little bit more about what this is all about.
It's been lovely to work with you two handsome roosters this year. I've had an absolute ball, learnt a lot as well. As have many of your listeners, I did put the call out to the wonderful Chanticleer audience who did not let me down. They listen to you in all sorts of places. Check out their messages from 2025.
It's Andy from Darwin here.
Craig from Brisbane.
Olivia from Bronte here.
I recently moved to Dubai and I'm missing home quite a bit.
I'm an Australian who recently moved to Chipiona in Spain.
This is Devinder from Adelaide.
Jack here from the beautiful Central Coast in New South Wales.
It's Lucy from Queensland.
Hey Chooks, it's Nick from Adelaide.
Just listened to your show while chopping down banana trees that fell over in Cyclone Fina.
I really enjoy listening to you guys on a Monday morning, driving from Brisbane to Yatala.
John from Hobart. I listen to the boys while I'm doing my weekly housework.
I listen to you every Saturday morning in the sauna while I sweat out the week.
I particularly listen to you guys when I drive to jiu-jitsu training.
I listen every Saturday while doing parkrun.
I listen to your podcast when I'm out and about in my truck, with my dog.
I listen to the pod at work as an electrician.
Listening in on the drive to university.
I listen from around Australia, from Yarra Park to the Fremantle Wharf, outside the ASX and the inner suburbs of Adelaide.
I like to listen to the Chanticleer podcast on a Monday morning after I get my 3 kids off to school, while I go on a morning run.
I put you guys on in the car on a Friday night when I need to go and do a late pickup across the other side of Melbourne with 2 kids.
The weekly breakdown helps a busy working mum like me keep up to date on the stuff I don't always have time to read.
Thanks guys for sharing your expertise, taking me from financial dummy to, well, a bit smarter.
Keep it up. Look forward to next year.
Keep the insights coming. My sauna wouldn't be the same without you both.
I love your wisecrack, my favourite being pissing in the rain. Keep up the good work.
Thanks for moving the narrative faster than the traffic.
Love the laughs. Merry Christmas.
Hope you both have a fantastic Christmas and New Year's.
Just wanted to send in a massive thank you for an awesome year on the Chanticleer podcast.
Catch you next year. See you, legends.
Anthony, how bloody good are our listeners? That is absolutely fantastic. Massive thanks to everyone who contributed. I'm not entirely sure how I feel about being in the sauna with that lady every week, but I'm very pleased to be able to connect with our listeners wherever they are, I guess.
Yeah, a bunch of bloody legends, James. They're a real diverse crew there. I'm glad we got the comments off the parents. I'm sorry to all the kids in the car that sound like they have to listen to us rabbiting on as well. It's great. We've really got a diverse crew out there. You know, I thought we spent most of our time just talking to, suits in offices, James, but it turns out it's much broader than that.
It's great to hear that it's resonating, and massive thanks to all our listeners who sent a contribution in, all our listeners who've sent questions in over the course of the year, and a huge thanks to Mandy for pulling that together. That's so special, and we really appreciate it.
Absolutely. Well, James, this wraps up our final episode on the Chanticleer podcast for this year. I just want to say a special thank to our editors and our guest hosts, James Chesler and Cosima Mariner, and Johnny Shapiro and Joyce Moulakis, who also joined us on an episode this year.
Yeah, they did a brilliant job, Anthony. But the biggest thanks at the Chanticleer podcast has to go to our producers. Mandy Coolin, who you just heard from, joined us midway through the year after we said a sad farewell to our mate Lap Fan, who I reckon is listening. I don't know if he's in a sauna in Vietnam, but I reckon he's in a pool somewhere in Vietnam.
Yep.
Merry Christmas to you and yours, Lap. And, of course, Alex Gow, who has steered the Chanticleer podcast for the last couple of years. Anthony, this is really a team effort every single week. And while the listeners hear our voice, it's the work that goes on behind the scenes, putting the podcast together, correcting our mistakes, pushing us to think about different perspectives, occasionally being the conscience of the podcast too. Our producers do such a brilliant job, and Mandy and Alex, we can't thank you enough, and we love you both very much. So thank you. And Anthony, finally, thanks to you, mate. This is one of the highlights of my week every week is talking crap with you for half an hour or occasionally longer, and it's really so exciting and touching to hear that other people enjoy listening to us talk crap too.
Yeah, sure is, James. Like you said, it's a team effort, but you're indisputably the team captain. Thanks for all the work you put in behind the scenes as well. I mean, a lot of people don't see it, but you are the real engine and the driving force behind this. So thank you very much.
Oh, very kind, Anthony. And on behalf of everyone at the Chanticleer podcast, we wish you a Merry Christmas and a great break. I reckon 2026 is going to be a huge year. So make sure you get some good downtime and come back ready to go with us in February. Can't wait to see you then. Thanks for listening all year. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coolin and Alex Gow. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
Another sunny afternoon.
Ho, ho, ho! Merry Christmas!
The Australian Financial Review.
A new true crime podcast you need to hear to believe.
I need police right now. I've just started broken into my house.
2 men dead at the hands of a teenager, and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures is killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.